April 24th, 1893. Inside the Treasury building in Washington, D.C., John G. Carlyle was 58 years old and had served as Treasury Secretary for only 6 weeks. The figure sitting before him was one every Treasury Secretary since the Civil War had been warned must never slip beneath a certain threshold. That threshold was $100 million in gold reserves. It was not formally established by statute. Instead, financial markets had come to view it as the dividing line between a government capable of meeting its commitments and one that might struggle to do so. The reserve had now dropped below that mark. Carlyle was not responsible for creating the crisis. He had inherited it from legislation enacted 3 years earlier, the Sherman Silver Purchase Act. That law required the Treasury to acquire massive amounts of silver each month and issue notes backed by those purchases. Those notes could then be exchanged for gold. The measure had been crafted as a political compromise. It sought to satisfy silver-producing states in the West, while preserving the gold standard favored by banks in the East and creditors across Europe. It attempted to uphold two monetary promises that fundamentally conflicted with one another. For 3 years, the arrangement appeared to function. Then it failed. 3 weeks later, on May 5th, the National Cordage Company entered receivership. The company had no direct connection to the gold reserve problem. It did, however, represent a different vulnerability. Its expansion had been financed through layers of borrowing that far exceeded the cash flow the business could realistically generate. Within 5 months, 500 banks collapsed, 15,000 businesses failed. Unemployment climbed to levels the United States would not experience again until 1933. The Panic of 1893 became, and for nearly 4 decades remained, the most severe economic depression in American history. Its origins lay in a railroad boom that few wanted to acknowledge as a bubble, and in a gold reserve that many refused to admit had effectively vanished already. To understand 1893, it is necessary to examine what had expanded before the collapse. Silver was not the underlying fuel, it was merely the spark. The real source of pressure came from somewhere else entirely. Throughout the 1880s, American railroad companies laid track at a speed far beyond what freight volumes and passenger demand could support. Between 1880 and 1890, total railroad mileage across the United States approximately doubled. Much of this expansion was funded not by profits, but by borrowing. Huge volumes of bonds were sold to investors in New York, London, and Berlin. The expectation was that future traffic would eventually justify the network that had already been constructed. That expectation did not materialize quickly enough. By the early 1890s, several major railroads were operating under extreme financial strain. Many were paying interest on older bonds by issuing new ones, a process that can continue only as long as fresh investors keep buying. The Philadelphia and Reading Railroad failed in February 1893. The Erie Railroad collapsed soon afterward. These were not small regional operators. They ranked among the largest corporations in the nation. Their downfall revealed how much of the railroad expansion had depended on leverage rather than sustainable earnings. National Cordage reflected the same weakness in a different form. It was not an infrastructure company. Instead, it functioned as a holding corporation that had brought together rope manufacturers, borrowed heavily to finance those acquisitions, and then watched its share price soar to roughly 3 times its previous level. That rise was driven largely by investor expectations about future consolidation gains, rather than by profits generated from the rope business itself. When the banks that had extended credit to National Cordage demanded repayment, the company lacked the resources to meet those obligations. Its shares crashed in a single trading day. The impact went far beyond one company. Fear spread rapidly through financial markets that were already unsettled by concerns over railroad liabilities and shrinking gold reserves. This is where all 3 stories converge. Faith in paper assets exists only because people believe those claims can be exchanged for something tangible whenever they choose. Once a large number of holders attempt that conversion at the same moment, the system is forced to reveal whether such redemption was ever truly possible on a broad scale. In 1893, 3 separate sectors faced that test. The answer was the same in each case: no. Now consider the United States in 2025. Watch closely as the same 3-part framework begins to take shape again, although under different labels. The excessive infrastructure expansion that defined the railroad surge of the 1880s has a modern counterpart. Artificial intelligence data center development. Industry analysts estimate that planned spending on AI infrastructure during 2025 alone exceeds $400 billion among the major hyperscalers. Over the coming years, total committed expenditures extend into the trillions. A significant portion of this funding is not coming from present operating income. Instead, it relies on debt issuance, off-balance sheet arrangements, and increasingly complex joint venture structures designed to prevent the full borrowing burden from appearing clearly on any one corporate balance sheet. Railroad companies in the 1880s believed future freight volumes would eventually justify the tracks they had already built. The AI expansion of the 2020s rests on a similar expectation. The assumption is that future enterprise demand and consumer demand for AI services will ultimately justify the computing capacity being constructed today. At present, no one can say with genuine certainty whether that assumption will prove correct at the scale of capital now being committed. The next piece is critical. National Cordage became the speculative company whose collapse was remembered long after the broader weaknesses were already embedded throughout the system. A comparable candidate appears visible in 2025. Several businesses connected to the AI sector are valued as though they will deliver decades of continuously accelerating profit growth. No technology company in history has sustained such performance for that length of time. When even one of these firms falls meaningfully short of earnings expectations, market reactions during 2025 have already displayed the same pattern seen with Cordage. The response is sudden, it is severe, and it is often far larger than the company's actual weight within the wider economy would suggest. The Sherman Silver Purchase Act represented a government effort to maintain two commitments that increasingly conflicted with each other. A modern parallel exists in the position of the Federal Reserve. The Fed is attempting to preserve a credible inflation objective while also supporting a treasury market tied to a government running annual deficits of $2 trillion. Those goals are moving into greater tension. Lower interest rates help support a treasury carrying heavy debt and a stock market dependent on leverage. Higher rates reinforce confidence in the dollar and strengthen the inflation target. The Fed cannot completely achieve both objectives at the same time. The Treasury of 1893 faced a similar dilemma. It could not fully maintain gold convertibility while also purchasing silver at a fixed and favorable price under political pressure. There is, however, one specific factor that makes 2025 fundamentally different from 1893. And the difference is not necessarily comforting. In 1893, the American economy was comparatively self-contained by global standards. The crisis was extremely damaging, yet it remained largely an American event. European creditors faced exposure mainly through particular railroad bond investments rather than through the entire structure of global finance. Today, similar pressure moves through markets that serve as the foundation collateral for the global financial system. The Treasury market functions as the primary safe asset held by pension funds, insurance firms, and central banks across the world. At the same time, the private credit sector has expanded dramatically. Valued at $1.7 trillion, this market barely existed in its current structure 15 years ago. Its growth has been driven by lending to highly leveraged businesses, the same type of borrowers that, in 1893, would likely have relied on railroad-style bond financing. A substantial share of these private credit holdings sits inside life insurance portfolios and retirement funds. They are woven so deeply into ordinary savings plans that many pension holders are unaware of their exposure. In 1895, J.P. Morgan personally assembled a private banking consortium to support the Treasury's gold reserves. He supplied gold directly to the government because no other institution possessed sufficient capital or credibility to accomplish the task. No comparable private figure exists today. The financial system has become too vast. Only the Federal Reserve maintains a balance sheet operating at a similar scale. That creates a unique situation. In any major liquidation event during 2025, the institution expected to provide support is the same institution already attempting to manage the conflicting pressures that helped create the strain. This is why the phrase, "the 100 trillion liquidation has finally begun," should not be viewed as a forecast of a single future event. Instead, it describes a process already unfolding across several markets at once. The $100 trillion figure combines federal debt, unfunded entitlement obligations, corporate debt that must be refinanced at higher interest rates, along with private credit exposure and leveraged loans embedded within retirement accounts that many savers never see. This is not one isolated bubble waiting for one specific day to burst. It is the structure of 1893 rebuilt on a scale that makes the railroad bond market of the 1880s appear insignificant by comparison. The panic of 1893 did not arrive with an official warning. Its arrival became visible when a Treasury Secretary watched a critical figure move below a threshold that markets had quietly accepted as important. At nearly the same time, a rope company that few people beyond Wall Street recognized suddenly became the most closely watched stock in America during one disastrous week in May. Carlyle spent the remainder of 1893 and much of 1894 attempting to contain a crisis that had been made structurally unavoidable by the silver policies of the previous administration. He did not create the conditions. He inherited the numbers. And eventually, the numbers produced the outcome that arithmetic always produces. The indicators being monitored in 2025 carry different names: Treasury market liquidity stress measures, private credit default rates, artificial intelligence capital expenditures as a share of GDP that now exceed levels not witnessed since the railroad expansion era itself. Yet the mechanism linking them remains unchanged. It is the same force that connected gold reserves, National Cordage stock, and railroad bonds in 1893. Confidence in paper assets is tested simultaneously. The result reveals whether the promised conversion can truly occur at the scale advertised. As this story concludes, one question remains. In 1895, J.P. Morgan possessed both the resources and the reputation necessary to support the Treasury at the height of the panic. Today, no private institution commands a balance sheet remotely comparable relative to the size of the modern financial system. Does that mean a liquidation event in 2025 could be stabilized more quickly because the Federal Reserve can intervene on an unlimited scale? Or does it mean that once the Federal Reserve itself becomes part of the pressure, no effective circuit breaker remains? Share your perspective and continue following these critical thresholds as they develop.